Anyway, so Bitcoin's basically where it was yesterday. We had a bit of a drop yesterday because of CPI and PPI reporting numbers, which I'll cover a bit. Today, I'm mostly going to talk about big, kind of high level macro stuff rather than crypto specific things, because really at this point, we're kind of at the mercy of the greater winds of change and where we go from a macro global economic standpoint. So, mixed bag today, a little bit on the red for some of these, so not too big of a deal, 1.5%. Still up near in the 90s. We still just keep bouncing around between 90 and 110,000, still into that range. And if we take a peek over at crypto fear and greed and then Bitcoin fear and greed, we've bounced up. So on the Moonstream webinar, I'd covered this that we were at 35, which felt maybe not like a bottom, but pretty damn close to it. And sure enough, we look at the last 30 days. That was the bottom, actually, as far as the fear and greed goes. We were at 35, and then we bounced up. Now we're at 40. Doesn't mean we're out of the woods yet, but if we look at this, the last time we were in these deep orange packets here, that's when the market was the most fearful. That was the end of August, beginning of September. That coincided with the market bottom in altcoins, and then we just went, ripping over the next several months. We're bottoming here right now after a big pullback in alts. So I would expect a turnaround as well, since sentiment is oversold, in my opinion. Now, if we look at the Bitcoin fear and greed, we're right back to neutral. So for the last couple of days, we were actually a little bit in fear at 46 out of 100. So the sentiment has improved just a touch, but you can kind of see here that really since the highs of January 22nd, when we were at 109,000, right on the top there, we've drugged down a little bit, and we got down into the fear. Everybody's thinking, oh no, the crypto market's over, the bull market, excuse me. We got to 43 out of 100, so pretty low. And if we look at the past year, the last time we saw drawdowns of any, this type of size was during the summer, right? Remember, we had that endless just drag from the previous high of 70 grand in March of 2024. That was after the run from when Bitcoin ETFs launched. And then we just kind of like drug out all summer. Bitcoin bottomed, altcoins bottomed, and then we just went rip roaring after September up until the election. So a little bit after the election. So then we've kind of drug out a little bit, and I think it's probably time to reverse again. So let's talk about all the macro. Let's talk about, actually, I'm going to start with CPI first, and then I'm going to go into global macro, and we'll go from there. Cool. Okay, so CPI, this was the thing that I'd kind of warned about on the Moonstream webinar that could lead to a little bit of a rocky week until the market digests this. Ever since inflation has been high in the US, these Fed meetings to announce the rate cuts, rate raises, or nothing, and CPI, PPI, jobless claims, so on and so forth, those always serve as a thing for people who are hyper attuned. They're not staying long and chill, but people who actively trade these markets. This is a very gyrating period anytime these announcements come out. So if it's good news, market goes up. If it's bad news, people instantly sell into it, and then we just kind of bounce from there. So inflation rises unexpectedly, complicating the picture for the Fed. So the things are getting a little bit different here. So if we take a look here, by the way, a quick cheat code for you. For those of you who are ever looking at any kind of site that has a paywall, so let's say in this case, New York Times, Wall Street Journal, you name it. They always want you to pay, blah, 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 and that's fine. But you can just go to this website, archive.ph. In fact, I'll just do this. I'll show you how this works. So archive.ph. Okay, I'm on a VPN, so it's going to make me verify. And if it makes me go through a bunch of this crap, I'll just skip it. But this is a really slick tool. There we go. Okay, so this is what it looks like. If you go to one of those pages and it hits you with a paywall, go over to archive.ph, copy that link to the page you want to see. And then I always search in this blue bar, this bluish black bar first. I want to search the archive for saved snapshots. So what happens is you go and save a snapshot. So let's go to New York Times, just for reference. Whoops, that's New York time. Let's go back. New York Times. And let's find an article. And this might hit me with a paywall. Yep, okay, pay. So I'm going to click and copy this link. I'm going to go over here to this blue bar, paste it, and I'm going to search to see if anyone else has made a copy of it. So basically, if not, if it says we don't have anything for that, then go paste it in the red bar. It'll go and take a snapshot of the page and then give you the whole thing. So in this case, I'm going to search for this. Yep, someone's already done the same exact thing. They've done the work for me. I click this link, and then it takes me to the archive.today web page capture, and then I can go read the whole article without stupid ads or without a paywall. There you go. So there is your cheat code today for avoiding all paywalls. Hopefully, I just saved you some time and some annoyance and some money, which is archive.ph. There we go. Okay, so let's continue on. So inflation rose. So you can see this chart here. We have a bit of a jump. So we had a huge run up during 2021 and then a big drop, and 2022 as the Fed cranked up rates. We're dropping, 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 dropping. Things are looking good, but we got a big rebound right here. This last little tick. I can't really zoom in much further than that. But so inflation rose to 3% in January, strengthening the case for the Federal Reserve to extend a pause on interest rate cuts. The CPI Consumer Price Index jumped more than expected. Data from the Bureau of Labor Statistics showed on Wednesday, rising 0.5% from December, and what was the fastest monthly increase since August of 2023. Now, this could just be a short term gyration, but it's not good to see this thing rocket back when we were making good progress. Last month, the annual pace was 2.9%. So now we're at 3. We've jumped up. Core CPI rose 0.4% from December, or 3.3% on a year-over-year basis, both higher than economists expected. So anytime, it's like when a stock doesn't meet Wall Street expectations, people hit the sell button. When CPI and PPI and core and all these things don't hit expectations, and even worse, they increase, when that's not expected, the market gets a little spooked and they pare down their exposure to, all basically risk assets. So the monthly increase in the core prices was the highest since April of 2023. So we really did, we saw this jump right there, a little bit of movement. We saw some downward pressure, and then we just had this big lift. So that's not really what we want to see here. So Mr. Goolsbee, who's president of the Federal Reserve Bank of Chicago, Mr. Goolsbee, who will cast an official vote on policy decisions this year, said he did not want to read too much into one inflation report since it followed 2 months of more encouraging developments and noted that seasonal quirks were typical in January data. So he's basically saying, don't panic. We need a little bit more data to really make a definitive decision. But he made it clear it was an unwelcome development. There's no question if we get multiple months like this, that our job is clearly not done here. Last month, price increases in sectors closely watched by consumers, from groceries to gasoline, offset declines in other categories like clothing and furniture. So there's kind of a mixed bag, is what they're saying here. So economists did not expect that many of these items that increased to continue rising, however, suggesting that January pace may not be sustained. So fuel went up dramatically, used cars and trucks a little bit more. All items were up roughly 0.5%. And this is a weird basket. Your mileage may vary, as they say, because everybody's basket of goods is totally dependent upon their lifestyle, their purchasing habits, so on and so forth. So it doesn't mean that everything went up 0.5%. It just means that on aggregate, how they weight this basket went down there. So, Jonathan Wright, a former Fed economist, said the latest data, quote, reinforces the picture of inflation getting stuck around 3%. And that last percentage point is becoming very difficult to achieve, referring to the Fed's 2% goal. He said that rate increases from the central bank is, quote, at least as likely as a rate cut in the near term. And, we weren't really, the market wasn't looking to have any rate cuts until about June. I think now, after this data, the market is actually signaling they probably don't expect any rate cuts until December. So we're going to have high rates all year long. So we'll talk a little bit more about Trump and all of his tariffs, deportations, tax cuts, deregulation, all that stuff. But the risks are to higher inflation and lower growth. And those things are bad. We don't want to see that. Ultimately, all of the stuff comes down to the idea that with crypto specifically, with retire rich investments, is that we want to see rates come down. We want to see inflation come down. More liquidity begets higher prices. And the second, third order effects is if we see these numbers where inflation stays higher than expected and jobless claims don't add up and PPI and CPI and core don't look good, then not only are the Fed not going to cut rates, which increases our bags, moreover, the fear is that if inflation starts getting rearing up again because Trump does something really, really stupid, like implements tariffs across everyone, which makes everything far more inflationary, then we could see the Fed actually raise rates, which is very bad for the crypto market, for the stock market, so on and so forth, as we remember from 2022. So we got to watch that. So anyway, the Fed has signaled little urgency to lower rates this time for the time being, setting up a potential clash with a president who showed in his first term a readiness to critique the central bank when it resisted his cuts or demand for cuts. Trump is very much ringing the bell, says we need to lower rates. And I get that because that makes assets go up. However, it also crushes the poor and the middle class because inflation really, really hurts when you don't have a tremendous amount of excess capital and you don't own assets, right? So, I get it. It makes the stock market go up and makes your house price go up. But for the middle class and poor, it really crushes everybody. So, anyway, over at least a longer term horizon, households and businesses do not seem to be losing faith that inflation will eventually move lower. That said, this guy, Mr. Goolsbee, said that gave him some comfort because the world views this not as a permanent shift and not an indication of an extended overheating of the economy. And that is good. When the economy overheats, that's usually when the Fed steps in and starts raising rates. And that's something we want to see. But we've got a lot going on here. Jerome Powell, Fed chair, referenced the latest inflation data and said that it shows that we're close, but we're not there. Mr. Powell said that while there has been great progress on bringing inflation down, we're not quite there yet, so we want to keep policy restrictive. So no big money printing yet, right? No urgency to lower rates so long as the labor market stays solid. They'll need to see more substantive progress in inflation coming down before again pulling their policy levers. So with the labor market, what they want to see is higher unemployment. Not that they want to see that, but that in order to lower rates, right now we have damn near record lows in unemployment, which sounds great. Everybody gets a job, right? The issue is that while the job market is super strong, then the Fed doesn't really get to pull the lever, right? So the reason that they slammed down rates again was during COVID. Jobless claims went through the roof. And then that fear of, oh no, we could have like 10, 20% unemployment like the Great Depression, they just cranked the money printer, right? But when the job market is super strong, they don't really have an incentive to lower rates. They don't need to encourage businesses to hire more people when we already have near record low unemployment. So we're kind of in this thing where all roads lead to what second and third order effects of what's going to happen is going to lead the Fed to either keep rates high or lower them. So after the inflation report, traders in the federal funds futures markets scaled back their bets about when the Fed would lower interest rates, pushing back the timing from September. Okay, I was wrong. I thought it was June. They had already apparently dropped it lower or later. From September to December, the worse than expected data sent U.S. stocks and government bonds tumbling. So that's why we got that pullback yesterday, and we're kind of bouncing a little bit today. Now let's talk U.S. weekly jobs claims. Those declined amid a stable labor market. So the jobless claims actually went down, meaning the labor market is strong, which then means the Fed doesn't pull the, crank the money printer, lower the rates lever. So the number of Americans filing new applications for unemployment benefits decreased last week, suggesting the labor market remained stable early in February. Claims have trended lower so far this year, consistent with historically low layoffs.
Hey, this is Brett from Moonstream. If you'd like to learn more about our pro trading signals or our live classes every Wednesday or our Retire Rich program, go over to moonstream.io/start.